Friends, thank you for being here today. What if I told you that the price chart you are looking at is lying to you about the true availability of the world's most critical industrial metal? And could it be that while the Western world is distracted by a fraction of a percentage point in interest rates, the East has quietly checkmated the global supply chain? We stand at a precipice in financial history that few recognized until the ground began to crumble beneath their feet. On December 9, 2025, silver crossed the $61 threshold, touching $62 per ounce. For the casual observer or the momentum trader, this appears to be just another bull market rally. Perhaps a squeeze reminiscent of 2011 or the speculative fever of 1980. However, to view this event through the lens of standard market cycles is a catastrophic error in judgment. We are not witnessing a temporary fluctuation. We are witnessing a structural repricing of a strategic asset that has been drained, leveraged, and now effectively weaponized. The events unfolding throughout December 2025 are not random. They are the culmination of a decade of structural deficits colliding with a masterfully executed geopolitical strategy. While the media fixates on the Federal Reserve's internal paralysis, a far more consequential drama is playing out in the physical vaults of Shanghai and London. To understand why silver has rocketed to $62 and why this is merely the beginning, we must dismantle the narrative piece by piece, stripping away the noise to reveal the perfect storm of Chinese export controls, inventory depletion, and Western monetary confusion. Let's begin by examining the current market state, where we are seeing the breaking of historical records right before our eyes. The psychological impact of silver crossing $61 on December 9, 2025 cannot be overstated. It marks a new all-time record, shattering the ceilings established decades ago by the Hunt brothers and retested during the quantitative easing era of 2011. But unlike those previous peaks, the current price action is not driven by retail speculation or a frenzy of coin buying on Main Street. This rally is characterized by an ominous silence in the retail sector matched by a deafening roar in the industrial supply chain. We have entered what analysts are calling Phase 1 pricing. This phase is defined not by the panic of the public, but by the recognition of the professional. It is the moment when industrial manufacturers, those responsible for the production of solar panels, advanced electronics, and defense systems, realize that the physical metal required to keep their assembly lines moving is no longer guaranteed at yesterday's prices. The quiet panic among industrial buyers is driving this surge, forcing them to bid up prices to secure delivery against a backdrop of vanishing inventory. The catalyst for this sudden vertical move was not a single news headline but a realization of timing. Market participants are waking up to the fact that the sudden restriction of supplies from the East is not a reaction to market forces, but a synchronized move designed to coincide precisely with Western monetary policy uncertainty. The price of $62 is merely the market's initial attempt to find an equilibrium in a world where the second-largest economy has effectively removed itself from the global supply pool. To fully grasp the gravity of this situation, we must look east to understand China's strategic trap, known as the drain and lock maneuver. For years, Western analysts have tracked Chinese accumulation of gold, but they largely ignored the strategic maneuvering occurring within the silver market. What we are witnessing now is a two-phase trap that has been executed with surgical precision. This strategy began with Phase 1, the illusion of abundance. The setup started in October 2025. In a move that baffled many at the time, China exported a record-shattering 660 tons of silver in a single month. This was the highest monthly volume ever recorded in the country's export history. On the surface, this looked like a bearish signal, a flood of supply hitting the market. But we now understand this was a deliberate feint. Throughout 2025, the London markets had been under immense pressure, with silver lease rates spiking to an annualized 30%. This was a sign of a breaking system. By flooding the market with 660 tons of silver in October, China temporarily relieved that pressure. Lease rates dropped back down to 5% or 6%, and premiums normalized. Western traders, lulled into a false sense of security, relaxed. They believed the shortage crisis had passed and that the high prices had cured the supply issues. However, this massive export volume served a dual purpose. While it created the illusion of abundance in the West, it simultaneously drained domestic inventories within Shanghai to their lowest levels in a decade. It cleared the decks for the policy shift that was to follow. Then came Phase 2, the export blockade. The trap snapped shut with the announcement from China's Ministry of Commerce regarding export regulations for the 2026 to 2027 period. This was not a standard bureaucratic update. It was a fundamental restructuring of the global silver trade. Effective January 1, 2026, a new three-layer choke point would be implemented, making it nearly impossible for Chinese silver to leave the country. First, the new regulations stipulate that only state-certified enterprises with an annual production capacity of over 80 tons can export silver. This immediately eliminates the vast network of smaller producers and trading houses that have historically supplied the Western spot markets. These smaller entities are now cut off completely, their metal trapped within the domestic Chinese ecosystem. Second, even for the massive state-certified enterprises that meet the volume threshold, every single export transaction now requires specific state approval. This gives Beijing veto power over every ounce of silver leaving its borders, allowing the state to throttle supply based on political or economic objectives. Third, and perhaps most critical, is the domestic priority mandate. Exporters must now prove that domestic industrial demand, specifically from the voracious solar panel and AI manufacturing sectors, is fully satisfied before they are permitted to ship metal overseas. With China's solar installations projected to exceed 500 gigawatts, domestic demand is insatiable. This strategy effectively nationalizes silver exports without officially declaring an embargo. It is a blockade disguised as regulation, and it leaves Western markets, which had grown dependent on Asian flows to balance their deficits, completely exposed. The success of China's strategy relies entirely on the global inventory crisis, creating a mathematical depletion that the data now makes undeniable. The buffer stocks that have smoothed over supply-demand deficits for the last 5 years are gone. Let's look first at the collapse of Shanghai. In Shanghai, the physical drain has been relentless. By late November and early December 2025, inventory levels at the Shanghai Futures Exchange, SHFE, had plummeted to approximately 531,211 kilograms. In the context of global trade, this is a terrifyingly small number, roughly 17 million ounces, or about 515 tons. To put this in perspective, global industry consumes nearly 2 million ounces daily. The Shanghai vaults hold less than a few weeks of global industrial supply. The velocity of the drain is even more alarming than the absolute numbers. We observed days in November where 3% of the entire remaining stockpile vanished in a single 24-hour period. This is not organic commercial turnover. This is a run on the bank. Consequently, the Shanghai market has entered a state of severe backwardation, a technical anomaly where traders are willing to pay significantly more for immediate delivery than for future contracts. Backwardation is the market's way of screaming that it does not trust the future availability of the asset. Furthermore, we are seeing a disconnect in arbitrage behavior. Normally, if prices are higher in China, traders would move metal into the exchange to capture that profit. That is not happening. Instead, invisible inventory metal held by private dealers is being pulled directly into domestic industrial use, bypassing the market entirely. West of Suez, we see the vulnerability of London and the COMEX. The situation is equally dire, though masked by opaque reporting. The London Bullion Market Association, LBMA, claims to hold approximately 790 million ounces. On paper, this seems like a robust buffer. However, a deep dive into the ownership structure reveals the ETF lock. According to reports from Metals Focus, roughly 83% of the silver sitting in London vaults is allocated to exchange-traded funds ETFs. This metal is owned by investors and, crucially, it cannot be leased out or used to settle industrial delivery demands. The free float, the amount of silver actually available for trading and delivery, is near zero. The desperation in London became visible in October 2025, just before the Chinese relief exports arrived. We saw reports of the LBM airlifting physical silver from New York to London and, incredibly, leasing physical metal from China to prevent a technical default. Former banking executives have estimated that to normalize operations and cap the price, the LBMA would need to import nearly 150 million ounces, an amount equivalent to 88% of the entire registered stock of the COMEX in New York. The West is shuffling deck chairs on the Titanic, moving metal from vault to vault to create the appearance of liquidity. But the physical stocks are simply insufficient to meet the coming demand shock. Finally, we must acknowledge the U.S. strategic shift. The United States government has tacitly admitted the severity of this shortage. On November 6, 2025, the Department of Energy and related agencies officially designated silver as a critical mineral. This is a profound shift in classification. Silver is no longer just a monetary metal or a jewelry component. It is now recognized as essential for national defense. From the guidance systems and missiles to the contacts and satellites and the infrastructure of the green energy grid, silver is irreplaceable. By designating it critical, the U.S. government is signaling that it is aware of the supply chain vulnerability. However, realizing the danger and having the physical metal to mitigate it are two very different things. Meanwhile, as the physical market tightens, we witness the Federal Reserve's paralysis and policymaking in a vacuum. While the physical foundation of the market crumbles, the architects of American monetary policy appear to be fighting the last war. The Federal Reserve meeting on December 10, 2025, will be remembered by economic historians as a moment of profound paralysis. The internal division within the Fed is deeper than at any point since 2024. The minutes and public statements reveal a committee torn apart by conflicting mandates. On one side, the hawks, represented by officials like Cleveland Fed President Beth Hammack and Dallas Fed President Lori Logan, are arguing strenuously against further rate cuts. They see the inflation data, which hasn't disappeared, and argue that cutting rates now would reignite the price spiral. On the other side, the doves, led by San Francisco Fed President Mary Daly, are terrified of a nonlinear change in the labor market. They fear a sudden spiraling collapse in employment that moves faster than policy can respond. They are advocating for cuts to support the labor market, ignoring the inflationary fire that is smoldering in the commodities sector. The market, in its infinite optimism, had priced in an 87% chance of a rate cut, up from 30% just a month prior. Yet, the language from Chair Powell suggests that a December cut is far from a foregone conclusion. This disconnect creates volatility, but more importantly, it highlights the Fed's impotence in the face of a supply-side commodity shock. The Fed cannot print silver. They can print dollars to stimulate employment, or they can hike rates to crush demand. But they cannot manufacture the 150 million ounces of silver needed to balance the global deficit. By focusing entirely on the Phillips curve trade-off between unemployment and CPI, they are blind to the commodity warfare that China has launched. If the Fed cuts rates into this supply constraint, they will pour gasoline on the fire, driving hard asset inflation even higher. I want to pause here and ask you a question. Do you think the Western central banks have any tools left to counter this physical drain, or is the shift in power inevitable given the Fed's paralysis? Leave a comment below with your perspective. I really want to hear what you think. Underpinning this entire geopolitical and monetary drama is the structural deficit and the industrial necessity, creating an unbreakable floor. The year 2025 marks the fifth consecutive year where global silver demand has outstripped supply. The Silver Institute projects a deficit of roughly 149 million ounces for this year alone. This is not a temporary disruption due to a strike or weather event. It is a geological and industrial reality. Global production has plateaued at approximately 850 million ounces per year. Meanwhile, consumption has surged past 1.2 billion ounces. We have been filling this gap by eating into above-ground inventories. But as we have seen with the Shanghai and COMEX data, the cupboard is now bare. The nature of this demand is fundamentally different from the speculative bubbles of the past. In 1980, the Hunt brothers tried to corner the market for profit. The regulators simply changed the rules implementing Silver Rule 7 to crush them. Today, the demand comes from sovereign nations and critical industries. You cannot implement Silver Rule 7 against the People's Republic of China. You cannot regulate away the physics required to build a solar panel. The solar industry alone is projected to install 500 gigawatts of capacity. The shift toward higher efficiency N-type solar cells consumes significantly more silver per unit than previous generations. Add to this the explosion in AI hardware and the electrification of the automotive fleet, and you have a demand profile that is completely inelastic. These industries cannot substitute silver. A solar manufacturer cannot switch to copper without sacrificing efficiency to the point of obsolescence. Therefore, they will pay $62, $80, or $100 per ounce because the alternative is going out of business. We must also consider the India factor. While China controls the supply, India is absorbing the float. Indian demand has exploded, with ETFs accumulating over 20 million ounces recently. Furthermore, Indian banks are pegging silver at a 10-to-1 ratio for loan collateral, structurally integrating high silver prices into their financial system. This creates a secondary demand shock that the West has largely underestimated. So, let's look at the future outlook, specifically the price scenarios and timelines we face. Where do we go from here? If $62 is merely the opening salvo, what does the endgame look like? We are currently transitioning from Phase 1 to Phase 2. Phase 2 pricing will begin in earnest in early 2026, when Western industrial buyers realize that the Chinese export blockade is not a negotiation tactic, but a permanent new reality for the 2026 to 2027 window. Based on historical precedents and current data, we can project 3 potential scenarios for price action over the next 18 months. First, we have the lower bound scenario of $70 per ounce. This target represents the inflation-adjusted peak of 2011. This is the orderly repricing scenario where markets gradually adjust to the new supply reality without mass panic. This is the absolute floor for the market. Given the severity of the deficit, it is unlikely prices will remain this low for long. Next, we see the middle range scenario of $80 to $100 per ounce. This is the most probable path. This scenario is driven by supply chain premiums and aggressive warehousing. Just as we saw toilet paper hoarding during the pandemic, we will see corporate hoarding of silver. Solar manufacturers and electronics firms will stop trusting just-in-time delivery and start bidding for physical possession. We will see premiums on physical metal decouple further from the paper price, dragging the spot price up to the $80–$100 range as the only way to incentivize holders to sell. Finally, there is the upper bound panic scenario of $194 or more per ounce. This represents the inflation-adjusted peak of $1,980. This occurs if we see force majeure declarations, industrial giants formally announcing they cannot fulfill contracts due to lack of material. If a major defense contractor or a state-backed solar entity declares they are out of silver, panic buying will ensue. At this level, we would likely see direct government intervention, potentially including price controls or strategic stockpiling. The calendar for this crisis is set. On January 1, 2026, the export controls officially activate and the flow of Chinese silver stops. By February and March of 2026, the first delivery delays will hit Western ports. By the second quarter of 2026, the solar installation season peaks in the Northern Hemisphere, marking the point of maximum stress. And if the supply chain hasn't broken by then, the third quarter of 2026 opens the window for potential force majeure events. Before we continue to the death of the paper price, if you are finding this analysis valuable and want to stay ahead of these macro shifts, please hit that like button and subscribe to the channel. It really helps us bring you this critical data before it hits the mainstream. Now, we must address the death of the paper price and the institutional awakening, which explains why $62 is still incredibly cheap. Some of you might be looking at this $62 price tag and thinking, surely the train has left the station. Surely, after a 90% run-up in 2025, the smart move is to take profits. This line of thinking, while intuitive in a normal market, is the most dangerous psychological trap you could fall into right now. To understand why, you have to look beyond the nominal dollar price and examine the relative value of silver, specifically through the gold-to-silver ratio, GSR. Historically, the gold-to-silver ratio is the most reliable indicator of where we are in a precious metals cycle. In modern history, this ratio averages around 60:1. During the peak of the 2011 bull market, that ratio collapsed to 30:1, and in the fever pitch of 1980, it plummeted to 15:1. Today, even with silver at $62, because gold has also rallied past $4,200 an ounce, the ratio sits near 68:1. Think about what that means. Despite breaking all-time nominal highs, silver is still historically undervalued relative to gold. We are not at the end of a mania. We are barely at the halfway point of a mean reversion. If silver were to merely return to its 2011 valuation relative to gold, we would be looking at a price north of $140 per ounce today. If it were to hit 1980 levels, we are talking about numbers that sound fictional to the average investor. Furthermore, we must consider the sleeping giant that hasn't even woken up yet, institutional capital. Everything we have discussed so far, the Chinese drain, the solar demand, the Indian buying, has happened without the participation of Western pension funds, insurance companies, or sovereign wealth funds. These entities allocate trillions of dollars, and currently, their allocation to silver is effectively zero. They are holding bonds that are losing real value to inflation and equities that are trading at nosebleed multiples. When the fear of missing out finally migrates from the industrial procurement desks to the Wall Street asset allocation committees, the liquidity crisis will become biblical. If global pension funds decide to allocate just 0.5% of their portfolios to silver as a hedge against inflation, they will find that the metal simply does not exist. There isn't enough silver on Earth to satisfy even a fraction of institutional demand at current prices. The market is too small. The only way to fit that ocean of capital into this teacup of a market is for the price of the teacup to expand exponentially. This leads us to the final critical realization, the death of the paper price. For decades, the price of silver was discovered in London and New York through the trading of paper contracts derivatives that claimed to represent metal but were settled in cash. This system worked as long as confident Western vaults had enough metal to threaten delivery. That confidence is now gone. We are witnessing a decoupling event. The price you see on the screen, the spot price, is becoming a reference point only, a ghost of a dying system. The real price is the one being paid in Shanghai, in Mumbai, and in direct off-market deals between miners and tech giants. We are moving toward a bifurcated market where the paper price might say one thing. But if you want actual metal delivered to your factory loading dock, you will pay a premium of 20%, 30%, or 50%. This is the natural squeeze. It isn't a financial game played by speculators like the Hunt brothers who could be defeated by changing margin requirements. You cannot margin call a sovereign nation. You cannot force liquidate a strategic stockpile that China views as a matter of national security. The West is holding paper receipts for silver that doesn't exist, while the East holds the physical bars that build the future. The transfer of wealth is already underway, and it is flowing from those who hold the debt to those who hold the assets. In conclusion, let me leave you with this final thought. Friends, the move to $62 is not a bubble. It is the sound of the world's commodity markets breaking free from the suppression of paper derivatives. For decades, the West has been able to dictate the price of silver through futures contracts and leasing schemes, confident that physical delivery could always be sourced from the margins. That era is over. China has secured the physical metal. They have drained their exchanges, locked their gates, and prioritized their own industrial supremacy. The Fed is arguing over basis points while the foundation of the global industrial economy shifts east. The calculation is complete. The outcome is inevitable. We are moving from a world of paper promises to a world of physical reality. And in that world, the only price that matters is the one you must pay to actually hold the metal in your hands. The trap has been sprung. The question is no longer if a crisis is coming, but simply, are you positioned for what comes next?